Good evening, everyone.
Good evening, all the participants. We are again there, and I believe we are all connected with all of you again. This is maybe a kind of habit that we have developed now to be connected, to remain connected with you. I was actually talking with my family that I was thinking that I don't have any addiction. So now I think I also have an addiction of webinars, addiction of applause. You would be very happy that I normally become very happy when more the registrations are. And today also we have registrations to the extent of 2,000 registrations, and that's really a very good number for a subject which is only relevant to 3,000 insolvency professionals, bankers, and chartered accountants. And like, it was very difficult to understand that this is a subject which is even relevant for people other than insolvency professionals. So I actually had to make some efforts to let everyone understand that the first part is more relevant for bankers and the chartered accountants, the forensic auditors. And then the second part, which is more relevant for the insolvency professionals and the transactional auditors. See, the subject is so large that I was thinking that I should complete in one part, but it is not possible because any webinar for more than 2 hours is not really advisable. It is, people are not able to concentrate, and it is not appreciated in the audience. So this is now the kind of habit that I say that I have developed. So while we are waiting for the audience, we can talk about something again, the format of the webinar again. Ankit, you can tell about
a few of our panelists are saying that they are also addicted, and a few of them are saying that last Sunday they missed you because you did not come for the webinar and you broke the symmetry that is going on for maybe 2 months now.
I thought last Sunday, I thought that I will, first of all, I will prepare and then only I will announce. But then unless you fix a date for yourself, it never gets done. So I could only do it because this time I fixed a date. And then only because you see, in this period, yesterday I had to go to Chandigarh, and I know Thursday and Friday I was getting up in the morning at 4 or 5 and then working for the entire day and doing the research for all this, and then trying to add my own practical experiences after recalling my life, at what point of time I had experience of what kind of event. So that was all listed in the PPT, so that when I share with you, nothing is lost. So Ankit, I think you can tell something about the format, again, the same kind of a format.
So we will go by the same format that we have been following, where we will take questions every half an hour, and I will keep going through the questions that come in from the audience, and I will try and take most of the relevant questions at the appropriate time and take most questions possible.
So as I'm giving an alert, the first part is more important about the bank frauds, and it is important for the early warning signal. The entire RBI structure with this, we see that they have two parallel structures, one for the willful default identification and actions, and the other is fraud detection, reporting, and actions. These are two parallel structures which are going under the guidelines of RBI, and there is only one circular which talks about the forensic audit, and whereas this willful default circular doesn't even talk about forensic audit. The concept in IBC and the concept in RBI is much different. There are a lot of differences between these two concepts. There is nothing like preferential transactions under RBI, and hardly there is a few undervalued transactions which are covered under RBI circular also, because in case it is done with the intent of fraud, then it can be covered under RBI framework. Even so, like, I would also like to share with you that this time we had a collaboration with IBC Law.in, In fact, we are using ibclaw.in for our research for NCLT cases, NCLAT cases, Supreme Court, High Court, anything related to IBC. We are using ibclaw.in. So we found that appropriate for our profession. So we are happy to use that. We are also, because in the second part, we have some very important case laws, which we could get on ibclaw.in only. See, like, why this concept came in my mind, it was only because, see, like, as you all understand, maybe that I have I have an experience of about more than 700 COC meetings where I've been personally or virtually present. And I have seen in most COCs, wherever we talk about appointment of transactional auditor or a forensic auditor, any member would say that we have already got it done, so there is no requirement for getting it done. However, it takes time in convincing them that it is a different audit, and what you have got is a different audit. So based on this experience, that I thought that the clarification between the forensic audit under RBI and the transactional audit for the sake of change in name under IBC, the clarity has to be there. The difference must be understood by all, including the members of committee of creditors, including the RPs, IRPs. So that was the objective. So in today's session, we would cover the RBI framework of fraud, master circular regarding frauds, master circular regarding the willful defaults, and we also would like to compare that what is the difference at each point of time, that I would try to relate to the IBC law and the RBI guidelines where the difference is. So this is the objective. Like, in case we have all the I think we
can start now. It's already 4:07, and I think whoever will join in can.
Okay, so let me share my the screen with you. So I'll share my screen with you. I believe my screen is visible to all of you.
Yeah, it is visible now.
So I think I can. Okay. So as I said, that this the entire webinar, which is in two parts, would be on forensic audit under RBI guidelines and the transactional audit under IBC. However, the two parts has been divided in such a manner that the first part is primarily the RBI guidelines and the willful defaults and the actions that the banks can take, the criminal actions that the banks can take, and also the kind of what are the frauds and what are the willful defaults, a complete definition and the complete framework that is under the RBI guidelines, along with comparisons with the IBC. Whereas the second whereas this second part would be primarily on the transaction audits, various case laws so far, how to handle audit, how to get cooperation from the promoters, how to finally take up this matter in the resolution plan, who will take the benefit, how the litigation would be handled once the resolution plan is approved and the RP is not working, how the same will be contributed. Everything would be in the second part of the webinar. However, both the parts are very, very important, because whenever you talk to banks regarding the transactional audit or forensic audit, the banks will definitely say that we've already got it done. So their objective is different, whereas the IPs or the RP's objective is different. That's very, very important for all of us to understand. So for the first part, we say that the forensic audit under RBI guidelines, and we'll talk about red flag accounts and the willful defaults. So the basic circular, which is the for the entire framework, and the master circular was issued by RBI, which was dated 1st of July 2016, and based on this master circular, the entire fraud is a classification, it's reporting by the commercial banks. It is completely guided by this circular. This circular is applicable to all the commercial banks in the country except for the this RRBs, the regional rural banks, and it is the objective is basically the detection in case we have to just see the fastest objective is the basically prevention and detection of fraud, taking timely consequent actions, examining staff accountability and do effective fraud risk management, stipulated timelines. He's also given in the same circular for the actions, which is actually in the responsibility of a bank. Faster dissemination of the information by the RBI to the banks on details of the fraud, unscrupulous borrowers and related parties. This part is this is the most important difference is that when we talk about fraud, it also includes the staff of the bank. Even if the fraud is only done by the staff, the same circular is applicable. If the fraud is done in collaboration, in connivance with the borrower, then also the same circular is applicable. And in case the fraud is done only by the borrower, then again the same circular is applicable. So the objectives are different, and then we actually will see what are the kind of classifications of the frauds. The classification of the fraud, when we'll see, then I think most of the insolvency professionals will understand that this classification is different than the frauds what we talk about under the IBC. So this is basically the frauds have been classified according to the provisions of Indian Penal Code, so that the relevant section is applied. When we talk about the staff accountability, then they are actually trying Prevention of Corruption Act, or when they talk about the frauds by the borrower, then the different provisions of the Indian Penal Code is applied. So basic classification of the fraud is based on the Indian Penal Code, like the misappropriation and criminal breach of trust. Like when we talk about criminal breach of trust, it is much different from the breach of contract. When a borrower takes loan and there is a contract, and then there is a possibility of breach of contract, maybe because of various circumstances, but then the breach of contract is not a fraud, but the breach of trust is a fraud. Somebody who is not able to pay the installments or not able to do the compliances as required by the bank is not a breach of trust, but it may be a breach of contract, whereas the breach of contract is not a fraud. Misappropriation, of course, is a fraud. Fraudulent encashment through forged instruments, manipulation of books of account, or through fictitious accounts and conversion of property. So the fictitious account is again and again being talked about as far as the frauds are concerned. The fictitious accounts, manipulation of the books of account. And see, like I also start feeling that the chartered accountants are actually taking a lot of risk in case they are compromising in the reporting. So that also has to be, I have tried to cover that part also. Although it may not be liked by some of the chartered accountants, but yes, most of the chartered accountants would like that part is also covered under this webinar. Unauthorized credit facilities extended for reward or for illegal gratification. So this particular part is only for the bank staff. Cash shortages also for the bank staff. Cheating and forgery is again with, maybe it is bank staff or it is the borrower. Fraudulent transactions involving foreign exchange, it may have a foreign, it may be a kind of the transaction with the connivance of the borrower and the banker. So like the fraudulent transactions involving foreign exchange, I think Nirav Modi case or the Vikram Kothari case is known to all. So all those cases are basically fraudulent transactions involving foreign exchange. Any other type of fraud not coming under the specific heads as above. So that actually will depend. So let us understand here that what is fraud under the IBC. The fraud under the IBC is whenever you do anything with the objective to defraud the creditors. So that is the definition of fraud. You do anything with the objective of defrauding the creditors. That is the only one definition of fraud there. Whereas whenever there is an intentional transfer of property or assets to any other person, undervalued transfers. So in case the intent is also fraudulent, so then it can also be covered under section 49 as fraudulent transactions, as against section 45 where only undervalued transactions are considered. So the objective is also different, whereas I said the preferential transactions are not there as a fraud under the RBI guidelines, where the preferential transaction is a transaction to be reported under IBC. So I think we are not even covering the 50% in the forensic audit that we are getting it done under RBI circular, whereas our scope of transactions is much higher under IBC, even if it is restricted to the look back period, but yes, it is still much higher under the transaction audit as against the forensic audit. However, the forensic audit may even started, the banks might even say that it should be started at the disbursement level, whereas the under IBC, the role of twilight zone is very, very important. I will come and explain to you in detail what is twilight zone. So this is in case these are the frauds which then yes, the RBI has a new framework which is applicable to the accounts having bank exposure of 50 crores and above. And wherever the exposure is 50 crores and above, then the entire framework is like, and the first step is the early warning signals. And the bank has given about 42, 43 early warning signals for the guidance of the banker. And in case they see any one or more of the signals, then they can raise alert, and then they can, in case they find that yes, the early warning signals are correct and serious, then they can even classify that account as red flagged account. So this is a stepwise approach. So first of all, the early warnings and then the red flagging of the accounts. So the moment red flagging is done, immediately they require fraud monitoring group or any other group constituted by the bank. So the banks are guided by the RBI that they will have a fraud monitoring group within the bank, and it will immediately go to the FMG of the bank for next action. The RBI has also guided the banks that they would have one special committee of the board for monitoring and follow-up of frauds, that is in short called SCBC, as constituted by the bank. And then the RBI has constituted Central Repository of Information on Large Credits, CRILC. That's what is made by RBI. And then the RBI has also made a Central Fraud Monitoring Cell, which is located at Bangalore. So this is a framework which the RBI has created. Early warning signals, red flagging of the account, then reporting to the FMG of the same bank, then reporting to the SCBF of the same bank, then reporting to the Central Repository of the Information of which is set up by the RBI, and then reporting to the Central Fraud Monitoring Cell, Bangalore. So this is a complete approach, a step-by-step approach for any fraud which is more than 50 crores. So this framework has nothing common with the IBC. IBC has a different framework. IBC, everything has to be done by the RP, even without audit, without the transaction audit. With the transaction audit, the RP will give this reporting to the NCLT, adjudicating authority. NCLT will pass an order, and in case there is any criminal action has to be taken, that would be taken by IDBI. Nobody else can take criminal actions for any fraud or any kind of offense committed under IBC. So when we see the timelines under this RBI guidelines, the entire framework says that whenever an account is classified as a red flag, then the account would be immediately reported to CRILC platform. And within 21 days, it has to be reported to RBI. And in case it is multi-banking arrangement, so that the first two lines are basically for the single bank lending. And then now we start with the multiple banking arrangement, MBA. And within this multiple banking, in case any bank finds a kind of warning signals and flag it as a red flag account, then the bank will red flag it, and bank will immediately call a meeting for the consortium, JLF. So the JLF meeting, it will be discussed, and the JLF meeting will be called within 15 days. That's the obligation of the bank as per the RBI guidelines. So this, whenever there is an account where it has to be classified as a fraud, 60% share of the total lending, and that has to be consenting for flagging the account as fraud account. So then the forensic audit has to be done. So this is where only these two lines are there in the entire RBI circular, where it is said that the forensic auditor can be appointed by the banks. And in case it is a multi-banking arrangement, then 60% share, and it will be decided. In case it is a single bank, then the bank can decide, bank alone can decide. The forensic audit has to be completed in 3 months' time. Once the forensic audit is completed, within 15 days, again, the JLF meeting has to be called, and then the account has to be classified as a fraud. And after the forensic audit, from the red flag account, it would be classified as fraud account based on the report of the forensic audit. And in case the forensic audit is not giving any report, then the red flagging of the account can also be lifted. So the first step is early warning, second step is red flag, then step is the forensic audit, and after the report of the forensic audit, either declare the account as fraud or take it back to the cautious account. So then the red flagging also would be lifted. So then within 30 days of the report, in case the banks decide to consider this account as fraud, then within 30 days they have to report to CBI. There is a reporting structure, complete reporting structure. Then I'm talking about the special framework for more than 50 crores. So that has to go to CBI, and that to Joint Director CBI New Delhi. So this report has to come to Joint Director CBI. So for this purpose, if the forensic audit is initiated by a private bank, then the private bank has no power to go to CBI. Then the CBI complaint has to be filed by a public sector bank. However, in case the private bank has to take an action on its own, then the private bank can go to the serious fraud investigation cell of the Ministry of Corporate Affairs. Now, this is the structure for reporting frauds to RBI. The structures for reporting of frauds to RBI. The RBI has first made a central fraud registry. This is a web-based searchable database, and the banks are supposed to upload any information about fraud on the central fraud registry. Then there is another the fraud monitoring return that is required to be filed by banks to RBI, and the banks would be filing this return online whenever there is a fraud, and even if there is a nil fraud, then I think the return is required to be filed. Flash report for any fraud which is more than 5 crores is required within a week time of the fraud which is coming to the notice of the bank. Audit committee of the board shall monitor all the cases of the frauds in general. The banks are required to constitute a special committee. As I said, that every bank is supposed to constitute one SCBF, and the other is the other thing that I said was this was the fraud monitoring cell and the SCBC. This is what is required to be constituted by each bank. So this was the once the RBI is informed, and then it comes to the how to report the fraud to the CBI or state police. The RBI circular is very clear that based on the two factors. One is the amount of the fraud, and second is the bank. Is it a private bank or public sector bank? So there are different powers with the private bank, and there are different obligations with the public sector bank. And that too based on the amount of fraud, estimated amount of the fraud. So in case the fraud is in case the fraud is in a private bank or a foreign bank, and the amount is ₹10,000 to 1 crore, it would be the FIR would be filed with the state police. So if it is up to 1 crore, the private banks and the foreign banks, they can only go to state police. Then if this fraud amount is estimated fraud amount is more than 1 crore, then the private banks and foreign banks, they can go to SFIO, Serious Fraud Investigation Office, which is under the Ministry of Corporate Affairs, Government of India. The no reporting can be done by the public sector banks to SFIO, because the RBI circular very clearly says that the public sector banks can go to the CID or the economic offense wings of the state government, state police, or they can go to the CBI. Whereas SFIO is for private sector banks and for foreign banks. So when this the amount of estimated fraud is by the people in the public sector banks is between 1 lakh to 3 crores, then the complaint can be given to criminal investigation department of state government or economic offense wings of the state police. When the amount is between 3 crores to 25 crores, when the amount is between 3 crores to 25 crores, and where the staff involvement is there, where the complaint primary accused is staff, then it will go to anti-corruption department, anti-corruption branch of CBI. And for the same amount of fraud, which is 3 crores to 25 crores, if there are other people involved, then it will go to economic offense wing of CBI. Now, when the fraud amount is between 25 crores and 50 crores, then there is a banking security and fraud cell of CBI. The complaint would be filed with that cell. So as you probably would understand that the CBI has offices in all the states. So in all these states, and depending upon the amount of the fraud, and it will go to CBI, the state offices. However, in case the fraud is more than 50 crores, then it will come to Joint Director Policy, CBI Headquarter, New Delhi. So we have seen the nature of fraud, the identification of the frauds, the reporting of the frauds, and the criminal complaint of the frauds. So this is what is the kind of structure that the RBI has made and in these circulars. So Ankit, is there any question till now? Because see, this is now I would be starting the early warning signals.
So I will ask one question that has come up. This is from Mr. Amin Dayani, and he says that in case a private bank red flags the account and intimates the consortium, in case where lead banks in PSBs, so in that case, who will file the criminal complaint?
The criminal complaint will be filed by the public sector bank, and whosoever is having the larger share in the debt, that bank will be filed, or the lead bank will file. Primarily, the lead bank is also the person who actually has got the larger share. However, in the most of the stressed cases, if some banks is possible to recover some amount, then they become little lesser in the amount, but the lead bank will file the complaint. In case there is no lead bank, then the larger debt the bank will file the complaint.
So another question is from Mr. Partha Kamal Sen. He says audit committee is of the borrower. So
audit committee of the borrower is not relevant here, but we are talking about the audit committee of the bank. Audit committee of the borrower is not relevant here, because what we are trying to do is the RBI circular. RBI circular is not guiding the borrowers whether they have audit committee, but the company law is definitely guiding the corporates for having an audit committee. But under this RBI circular, there is no reference of any audit committee of the borrower.
Another question is that who will file complaint if only ARCs are present lenders?
The ARCs are present lenders, so they in fact are recovering the money on behalf of the banks, and they are in case they find any kind of fraud, I think they come into they fall into the shoes of the banker, and all Sarfaesi rights or all other rights of recovery, and then probably they would also be able to take action. That's what is my common sense which speaks, because see, all the ARCs are enjoying the same rights as the banks had it before assigning the debt to ARCs. So like in the earlier scenario, when it was even 5% and 95% security receipts, it was more of a recovery on behalf of the bank. But now, of course, when the scenario is changed, when the 90% is cash and 10% is the security receipts, then it might be considered as a change. But most of the ARCs have got no intention of filing criminal complaints, and because this circular as such is not applicable to the ARCs. The circular is very clearly applicable to the banks, and that to all the scheduled banks except RRBs. ARCs are not covered under the circular. ARC, I see like they might even use any of the provisions of the Indian Penal Code for putting some pressures, but they are not under obligation as the banks are.
Then we have a question from Mr. From Mr. C.A. Vimal Arora. He says that what happens if the complaint is not filed by the responsible person? In that case, where the forensic auditor is liable to do so. I don't think forensic auditor
No, forensic
is
auditor
required.
is only required to report, and it is not the duty of the forensic auditor to report to police or to the economic offense wing or to CBI.
Another question is, I think I will just skip a few questions. Whether ECB lenders are covered under the RBI circular?
RBI circular, this RBI circular is not covering if the ECB has been given, because see, even this the foreign branches of Indian banks, to my understanding, the foreign branches of the Indian banks are also not scheduled bank in India. The RBI circular is not even applicable to the foreign branches of the Indian banks, because the foreign branches of the Indian banks are not even scheduled banks in India.
If any one consortium member classified account RFA and subsequently fraud, whether all the other members are required to follow the same? This question is from Mr. Yogesh Nirkar.
No, it is not necessary that everyone should follow, because as I said that the 60% consent is required before the account is classified as fraud in case of multi-banking arrangement. So in case it is a single bank, then of course there is no question. And in case of multi-bank, 60% of the total debt owning banks will take a call on consensual basis, and one bank should not go and cannot go to file a complaint, criminal complaint.
I think
whereas the banks normally declare it as fraud individually. As far as the declaration of fraud I have seen, because the one bank can declare it today, and then the banks try to, because I have seen in various cases. See, one important part that I would like to say here, see, whenever we file an application to NCLT for fraud, for undervalued transaction with the fraudulent intent, the banks take the cognizance, and the banks normally get an information from our audit, and the banks also try to immediately start a separate parallel proceedings of red flagging and then fraud, and then reporting to the authorities for criminal action. So the whenever a fraud application is filed by an insolvency professional RP or a liquidator, so that should be considered as multiple activities will be started against the promoters, because the banks will also not keep quiet, because there is nothing which stops the bank, because rather the banks are not absolved from their responsibility in case the RP files a complaint to adjudicating authority, and then the banks are not absolved. Rather the banks become more responsible, because now the issue has come to the public surface and it has been reported. It has been the information has been publicly available to everyone that there has been a fraud, as reported by an auditor and also as determined by the RP. So then the multiple proceedings starts. One is the RBI and the other is the IBC. Yes, Ankit.
Then I think, so one question that is coming is that what is the definition of fraud for these guidelines, and how do they define fraud, or is it required to be in general parlance?
See, I think, as I said, that the categories of the fraud has been taken as per the Indian Penal Code of the Indian Penal Code. Now, Indian Penal Code has divided various kinds of offenses into various categories. So the categories that has been chosen by RBI for fraud, those are very clear in my second slide. In fact, I completely clarified that the kind of breach of trust as against breach of contract, misappropriation. Then I said that this fraud circular of RBI is applicable to staff as well as to borrower, and as well as a combination of the staff and the borrower. Where this is this particular circular is more relevant for staff frauds, and also So because the staff fraud and the borrower fraud, everything has the same structure of reporting and criminal complaint. So
I think you can continue now, and I will keep asking the relevant questions as and when. So I think this is all this was relevant.
Okay, so as far as the early warning signals are concerned, anyone who has been doing banking, or most of the chartered accountants also would be very kind of hands-on experiences with many of them. And then what actually the signals are whenever a person is under financial stress. So financial stress or even compliance stress. So you see, like this is a list which is given in the RBI circular. And I just want to talk about the ratio of the list, and not will go through the entire 43 points that has been given. So one particular category of this is the non-compliances of various laws. Whenever there is whenever there are signals that the borrower is not complying to various law, or depositing the taxes late, or depositing the workman obligations delayed, that should be considered a very big warning. Bouncing of the checks which are received from the high value clients, that also should be taken as a very big signal. Then of course there are many things like kite flying, evergreening of the account, the delay in the realization of the bills, frequent invocation of the bank guarantees and letter of credits. So the categories are primarily where the borrowers are always asking for additional facilities. See, there used to be a system of check refer. If the bankers are also connected with me today, they would recall the check refer system. Still, I think it is working in some of the banks. The check refer is like, my limits is say 30 crores are my limit, and every day I need some additional amount. And normally the public sector bank branch managers were having some power to give some temporary TOD, temporary overdraft. So the borrowers will come to the bank manager every day for some kind of a temporary overdraft, and the checks will come in the check refer register, and the bankers would approve it, the branch manager would approve it by using his own powers. So I think that is now reducing a lot because the banks are not comfortable with that system. If the private banks had never introduced this system, but the public sector banks actually had the system of TOD. If the frequent requirements of the TOD is also a very big warning signal, then the inspections are not getting done, stock inspections are not liked. So these are the various categories. One category is the financial stress, which can be seen by check bouncing, LC, devolving or bank guarantee invocation. The other is the compliances deficiency, and the third part is the non-transparency in the behavior of the borrower. So there are morely three kind of classification that I can do. The legal non-compliances, and anything which normally financial stress will lead to, and then the lack of transparency. So this is all listed here. So these are early warning signals, and the banks have been given this, and a kind of the banks are, most of the bankers are trained enough to kind of understand all these warning signals. And the chartered accountants doing the audits of these companies are also understanding that the company is under financial stress. So these warning signals are also helpful for the chartered accountants who are doing the statutory audit of the bank companies. They can also see the signals, and in case they see that the signals are very high, so they can also be alert while signing the balance sheets. They would also be very particular in verification of the current assets of the company, and then the fixed assets and the expenditure. See, once the warning signals are given, that means that everyone will become cautious, not only the bankers, but also the auditors and the suppliers also. So these early warning signals should become very popular, So I don't want to spend more and more time on this, because otherwise this 2 hours would not be sufficient for completion. So I can actually develop on each and every signal individually, but that would take a lot of time. So these are in total in numbers like 43, and the last is like the resignation of key personals, and that too is also considered to be a very big warning signal when the key people start leaving the company. And then another warning signal which I would come later on is the phoenixing, when the promoters start another company and try to transfer the business or do the similar business in that company. That should be taken as a very, very big warning signal, because that is called phoenixing. And then the other thing which is called is even if the business is not profitable, but the promoters will always prepare a rosy balance sheet, and the promoters will always show some kind of profit, and very small profit but high turnover. A very small profit and high turnover also leads to a very big warning signal, because the turnover is generated to avail more credit facilities. Profit is not declared to save income tax. So these are very, very, because you would see that in companies, the turnover is increasing and their requirement of working capital is increasing, their business cycle is increasing, but the profit is not increasing, because in case they declare profit, it will be taxable and the tax will have to go. So these are various warning signals. Then we come to the red flagging. The red flagging and the warning signals are actually same. The red flagging is a little advanced stage, which is called as official status. The warning signals will read to RFA status of the account. So the warning signals primarily would lead to red flagging, and the red flagging is only kind of a it's basically issuing guarded warning to the bankers and the stakeholders by just saying that the account is red flagged. These are some of the illustrations which I was trying to explain, and I can even take some time over here in explaining whenever the red flagging is done, or this can be used as an early warning signals also. So the concept of evergreening means the debt never comes down. The debt is repaid in one account and fresh loan is taken in another account. That's called evergreening. The bank might say that the accounts are standard, but the total debt would increase over year over year over year. So this is what is the evergreening of the account. Business cycle, in some of the companies you would see it is continuously going up. Inventory will go up, the sundry debtors will go up, and the borrower will always come to the bank that my business cycle has increased. I need to give more credit to customers, and I have more variety of goods now, so my inventory has increased. Whereas all that is in some cases only because of availing more credit facilities. Third-party confirmation of the receivables are not available. Physical verification of the inventory or the fixed assets is not allowed or not liked by the promoters. Market credit is also increasing constantly. So the balance sheet credit side is increasing, and the balance sheet credit side is increasing, because the genuine loans definitely has to come in the balance sheet. So when the credit side is ballooning, then the debit side, the asset side of the balance sheet has to match. So for matching the asset side, rather than showing losses over there, the companies would show stock, other current assets, receivables. That's what is the normal tendency that we've been seeing for this last so many years, and this has been very, very prevalent in India and even abroad. The primary reason is that the detection of default was not there. Nobody was interested in detecting a default. Nobody was interested in reporting a default. The banks were also interested in continuing with the borrower because of their own profitability in the branch balance sheet, in the region balance sheet, in the zone balance sheet, in the bank balance sheet. So based on all these reasons, these defaults were not even detected or reported by anyone. So those defaults finally it was continued and it took a turn of fraud at the end of it. Regular capital expenditures are also increasing, and I would actually give an example here. When I'm the liquidator of RBI Agro Limited, and I have a building at Bawal, which is constructed on about 7 acres of land, and the building's current market value is 9 crore. So when I look at the balance sheet, that building is capitalized at 1,210 crores in the balance sheet, and that to audited balance sheet. Nobody, every year the money was debited to the building for two reasons. Because the one, that the company wanted to show to the banks that yes, we have storage capacity, and other, that all the losses were being parked at capital asset or capex. So in case they don't show capex, then it would have been shown as the stock or as the losses. Both had already saturated. So the only option left with the promoters were to capitalize it as a building, because that's something that you can construct yourself by just making some entries in the books of account. So the chartered accountants can also see that there are some clients, they will always talk about how to take more loans, and they will also talk about the balance sheet that is more suitable for bank for taking and enhancing loans. They always offer high interest rates, and the other important part of these kind of borrowers is that they would actually live a very luxurious life. They would live their life which is beyond their means, and only to show to others that their business is doing well. They would have good luxury cars and very big luxurious offices, so that people come and they get some satisfaction that the company is big and the company is working well. They also unusually close association with the vendors or customers, regular parties with creditors. So any person who actually is doing more socializing with the suppliers, that also means that he would like to take more credit. The delegation of authority in the accounts department is very, very less. Anyone who actually is coming to the banks himself, and he is not delegating the work to the entire accounts department, and he would have only one or two runners, and then he would himself handle the banking. So he himself will be available for any bank meeting. So he would not have CFO, he would not have an accountant to talk to the bankers. So this is a very big signal that he is doing something fishy, and he has all the time to deal with the bank. So when would he be doing business? So any person who is enjoying larger facilities and still dealing with the bank himself, that is a very big signal, and that needs to be investigated. So as I said, the business cycle starts increasing, and the higher inventory of raw material, work in progress, finished goods, and higher credit periods, that actually means that the losses are parked to the current assets. As I said, the zombie company scenario, I will explain in my coming slides what is zombie companies. Diversion of funds out by padding up the purchases for the purpose of personal use of the funds, because this is also one of the very important part of the manipulation of books of account. Then when we purchase raw material without actual physical movement of goods, and we pay check, and somebody can take the cash back. Increasing the closing stock always to declare the profit, and the normal scenario that we have seen, some people, they are not even making entries for the rejections or the debit notes issued by the customers, not recording the purchase bills, for showing higher amount of profit. So the ballooning or swelling of the fixed assets without corresponding increase in the capacity, that also has to be inspected and seen very carefully, while the fixed assets are increasing, while the company's turnover is the capacity is not increasing. Asset verification is a primary duty of the auditor in case it is not verifiable. See, nowadays the auditor's duty is also like kind of increasing manifold. The one very, very important part that we used to do is the bill to bill reconciliation is very, very important. Third party confirmation is also very important. asset verification is the primary duty of the auditor, and in case not verified, it has to be reported. Auditor's responsibility in reporting is the same as this. So when this evergreening that we've discussed, business cycle, the third party confirmation that we've discussed. So these are the scenario that we've talked about, the early warning signals, and the next level of signals, which leads to an account for red flagging. Once the account is red flagged, then the reporting, then the forensic audit. If the forensic audit finds some fraudulent entries, then declaring it as a fraud account, then the reporting of the fraud account to various reporting structure that has been made by RBI and also made within the bank. Then once the reporting has been done to RBI, then based on the amount of fraud, it has to be reported to either state police, state CID, or economic offense wing of state, or the CBI, state level CBI department. And if the fraud is more than 50 crores, then the joint director policy at New Delhi office of CBI. So these are the kind of structure that we have under the fraud category of banks. So the criminal action that we have also seen, that the CBI will take criminal actions. In my coming slides, I will also show under what section the CBI normally take the criminal action, and see what is the kind of the criminal action possibilities are there. But then in the meantime, that I think we should also talk about the master circular on willful defaults, because these are two separate framework. One is the fraud and the other is the willful defaults. And there is a little similarity in the two, and not the very huge similarity in the two. The fraud has got a separate framework and separate structure under RBI, whereas the willful default has got a separate structure under the bank's own policy. Bank's own committees are there, but the reporting structure is also different in the willful default. The master circular for the willful default is again 1st July, but it is 2015, whereas the master circular for fraud is 2016. So this circular is also applicable to all the scheduled banks, excluding the regional rural banks and all India notified financial institutions, on willful defaults of more than 25 lakhs. So any default less than 25 lakh, this circular is not applicable. It should be a debt. It should be a debt which is on account of the banking transactions, including off-balance sheet transactions such as derivatives, guarantees, letter of credits. See, there are about 30 circulars which has been issued by RBI on the willful default, and however, everything has been consolidated in the master circular, and there is no mention of a forensic audit in this framework. So the two parallel the proceedings, one is for the willful defaulters and the other is for fraud. In the willful defaulters list, or whatever bank classify a person as a willful defaulter, then there is no forensic audit concept under the willful defaulters. But whereas in the fraud, there is a forensic audit concept. So what is willful default? Very clearly, we actually have to understand what is a willful default and what is a fraud. We have already seen fraud, or in case need be, I would again go back to the same slide for kind of a revision. What was the fraud, which also included the fraud done by the staff, employee, or a banker, and the fraud done by the borrower. So in the willful defaults, the one is that the default in payment of obligation even when it has the capacity to honor the said obligation. So this is a very big scenario that the borrower has the money, has the capacity, but is not honoring the repayment obligations. This is a willful default. Secondly, the default in repayment obligations where the funds have been diverted. funds have been diverted, and it is diverted within the business, or it is diverted outside the business. So they both are considered to be willful defaults. And then is the disposing or removing any of the fixed assets or movable assets of the company, which is given to the bank as a security. So whenever the bank goes and finds that the stock is not there, and the bank can always classify an account as willful default, because in case the stock statement submitted by a borrower is 100 crores and bank finds a stock which is much less than 100 crores, the bank can say that it is a willful default, and the drawing powers were being taken by the borrower on a fraudulent declaration, knowingly that the stock is not there. He submitted a stock statement which was false. That is called falsification of books of account. So that is also considered at times fraud, but mostly it will be considered as a willful default, because he will be considered as disposing of or the removing the stocks while it was there sometimes before. The identification of the willful default should be made keeping in view the track record. So it is also mentioned very clearly that it should not be on an isolated transaction basis. It should be on a track record, in case there are multiple incidences of willful default, or some kind of some people are regularly doing these kind of things, then only they should be considered as a willful defaulter. The default must be intentional, deliberate, and calculated. As I said, that the statement of stocks or statement of sundry debtors given, that should be simply by not paying the money of the bank would not be considered as a willful default. It has to be intentional, deliberate, and calculated. The grunters and the corporate grunters also would be considered as a willful defaulter in case they belong to the same promoters. However, with effect from September 2014, even if the grunters are non-group companies, they also would be considered as a willful defaulter. So this is a willful default where the categories are totally different. The default is totally different as compared to the fraud. Going forward, again, this is as I said, that the diversion of funds is defined separately under this circular. What is diversion of funds? The amount is again 25 lakhs and above, and the diversion of fund is actually very, very simple. In most of the businesses that you would see, that this kind of diversion is mostly done when the short-term working capital funds are used for long-term purposes and without any confirmation from the bank. The deploying borrowed funds for the purpose of creation assets other than those for which it was sanctioned. Transferring borrowed funds to subsidiary group companies or other corporates by whatever modalities. To see somebody taking loan here and then finally investing it somewhere else. Routing of the funds through any bank other than the lender bank, and see, like, this is something that the opening current accounts with some other banks, so that the bank should not take the cognizance to take control over the current assets or current funds of the bank company. So they open account in some other banks. Investment in other companies by way of acquiring equities, debt instruments without any approval of the lenders. Shortfall in deployment of funds vis-a-vis the amount disbursed. Like if the bank has given a loan of say 20 crores, whereas the amount deployed in acquiring that asset is much lesser. So that's called the diversion of funds. So the diversion of funds is anything which is more than 25 lakhs would be considered as diversion. And in case the bank tries to find, the bank will find this in most of the cases. This is very easy to find diversion in most of the financial statements. Siphoning of the funds is also one of the causes of willful default. Again, for more than 25 lakhs, it was on the diversion of funds, again 25 lakhs and above. Siphoning of the funds, siphoning is again defined as in case the funds borrowed from the banks are utilized for the siphoning of the funds, where the funds are taken for some other purpose and utilized for some other purpose. That's the siphoning of the funds. and use of the funds are to be monitored by the lenders. That's the requirement of the RBI circular. Meaningful scrutiny of the quarterly progress reports, and it is also stated in that RBI circular like what kind of monitoring is required. So meaningful scrutiny of the quarterly progress reports, operating statements, balance sheets of the borrowers, regular inspection of the borrower assets, periodic scrutiny of the borrower books of account and no lien accounts, periodic visits to the assisted units, system of periodic stock audit, periodic comprehensive management audit. Most important, I think, part what the participants would like to understand is like what are the penal measures if a person is declared as willful defaulter. Number one, one is the no additional facilities. Once a person is declared as a willful defaulter, he would be debarred from any institutional finance for a period of 5 years from the date of removal of their name from the list of willful defaulters as published, disseminated by RBI or the credit information companies. I'll come to the credit information companies also. Even while I was researching, I could also find a few facts about the credit information companies. The legal process against the borrower grantors and the foreclosure of the recovery dues. They see their loan accounts can be foreclosed. That's also one of the penal measures which is listed in the RBI circular. The lenders may initiate criminal proceedings against the willful defaulters wherever necessary. Wherever possible, the banks and the financial institutions should adopt a proactive approach for change of the management. As you understand, the change of management is now allowed under the SARFAESI Act also, and it is also like IBC is also something which can be used. So see, whenever we talk to our bankers that the promoters are interested in giving a resolution plan, and in the meantime we talk about that the application is being filed for fraud, then no banker is interested in accepting a resolution plan which is coming from the promoter, even if it is MSME, because they would say that the RBI circular would hit us, because the RBI circular is one side it is suggesting that we should start criminal proceedings against the promoters. The transactional audit has shown that there has been a fraud. They would have declared by now the willful defaulters, and then any proposal coming from the promoters is not accepted normally by the committee of creditors when it is mostly the public sector banks. And the reason is this circular which says that the foreclosure, no additional facilities, the change of management, that's everything is a kind of scenario which suggests them that they should not accept the resolution plan from the same promoters. Although we have facilitated this in the Insolvency and Bankruptcy Code while just amending the Section 29A for MSME by Section 240A. However, the banks are not really comfortable with accepting the resolution plans from the same promoters where they have been declared as willful defaulters, or they have been declared as fraud, or where the reason that we feel that the our committee is never interested in a proposal from the promoters where the promoters are also classified as willful defaulters, and RP is ready to file an application for fraud or any kind of transactions. So this is also one of the reasons then why we normally feel why the banks are not interested. So these are the circulars of RBI which actually resist that they should not further do this any kind of thing without change of management. So this is very important for all my participants, my friends who are chartered accountants like me, and as my son is also a chartered accountant, I am also a chartered accountant. So this is the kind of caution that we all should use. It is very clearly written in the circular of RBI for willful defaulters that wherever the bank find that the auditee is a willful defaulter, and there is some role of the chartered accountants also, the auditors also. So what is the role of the auditors in this case? Falsification of the accounts on the part of the borrower. If it is observed that the auditors were negligent or deficient in conducting the audit, then what are the responsibilities of the bank? So this is carefully all the chartered accountant must give ear to this particular line. So in case the borrower is classified as a willful defaulter, then it is the duty of the bank under the RBI circular to file a formal complaint against the auditor of the borrower to the following parties. One, to Institute of Chartered Accountants of India to examine and fix the accountability of the auditors. Two, while the disciplinary action is initiated or is pending before ICAI, the complaint may also be forwarded to RBI, the Department of Banking Supervision Central Office of the RBI. The complaint has to be formally given also to IBA, Indian Banking Association, for records and circulate the names of the CA firms amongst all the banks who should consider this aspect before assigning any work to them. RBI should also share such information with other financial sector regulators, Ministry of Corporate Affairs and CAG. So this is what is written in the circular. The banks are under obligation to do this. Now, who are the financial sector regulators as of today? Maybe it keeps on increasing. Today we have, other than the RBI, we have SEBI, we have Insurance Regulatory and Development Authority of India, we have Forward Market Commission of India, we have this Pension Fund Regulatory and Development Authority of India. So this is these are the financial sector regulators. So in case any of our borrower is classified as willful defaulter, and it is also the reason is also shown on us that the falsification of the books of accounts has been done, it has not been properly reported, it has not been qualified, then these are the actions which the bank is supposed to take. This is the action which our bank is supposed to take against the auditing firm. Then the reporting of the borrower to the credit information companies. The regulation, the credit information companies, I'll just give you a little bit of background. The Reserve Bank of India has an exercise of powers conferred by Section 5 of the Credit Information Companies Regulation Act 2005. And the rules and regulations framed thereunder granted certificates of registration to 4 companies. And the CIBIL that we know for the time being, that we know one that we know CIBIL, but there are 3 others which have been given the certificate to do this business of credit information companies, like Experian Credit Information Company of India Private Limited, Equifax Credit Information Services Private Limited, CRIF High Mark Credit Information System Private Limited. So like we say that one is this CIBIL, but there are 3 others. I have also started seeing this Equifax, some of the information that comes to us from Equifax. They have also started scoring our credit, the credit history. They have also started scoring. So that's also kind of these are the 3 or 4 companies which are there for information. So the willful defaulter, would be reported to credit information companies. Now, this is the mechanism that the RBI has provided for identification of any willful defaulter. One, that there is first is an identification committee. First of all, there is a proposal which moves from the branches for a willful defaulter. It actually goes to an identification committee. In identification committee, which is headed by an executive director of the company and also to the officers of GM or DGM, the committee will issue a show cause notice to the borrower, and they will give a personal hearing to a borrower. That's very important part of the process. Then this entire thing will go to the review committee, which would be headed by the chairman and the managing director of the company, along with the 2 independent directors and 2 non-executive directors of the bank for the review committee. So so then in case the identification committee and review committee both are saying yes, then only a person can be identified as willful defaulter, and the reporting will start only thereafter. See, most of the chartered accountants must have seen that their clients, they come to them and they seek suggestions that they have been called for a personal or a video meeting with the executive director in the process of identification of a willful defaulter, because they would make a representation there that we are not willful defaulter, it was a business failure, and we have no other assets which actually can be considered as siphoned off or diverted from the business, and we have no capability to pay. So this is the willful defaults, the process of identification. Of course, there has been some relief which is given to the directors who are non-promoters or the non-whole-time directors, and the action can be taken only against an officer who is in default, that's defined under section 2 subsection 60 of the Companies Act. So in case somebody is not a whole-time director or a promoter director, then of course it is they can be exempted from declaring as being declared as a willful default. So what kind of criminal action? Now let us understand, once a person is declared as a willful default, what kind of criminal action can be taken against the willful defaulters? So the first of all, I said that it is the sense that the breach of trust or cheating has to be there in the operations of the borrower. Then the banks must monitor the end use of the funds. Then there may be some wrong certification by the borrower. So these are kind of forgery, breach of trust, cheating, wrong certification. These are some of the where the criminal action can be taken by the banks against the borrowers. So these are the two sections where the of Indian Penal Code which are used by the banks for taking any criminal action against the borrowers. One section is 403, which talks about dishonestly misappropriating any movable property to his own use. So most of the movable property which are hypothecated to the banks or pledged to banks, in case any borrower dishonestly misappropriates that property, shall be punishable with an imprisonment up to 2 years or with fine or both. That's section 403. And another section is 412 of the Indian Penal Code, which is used, and that is cheating. Wherever by deceiving any person fraudulently or dishonestly induces the person so deceived to deliver any property to any person, or to consent that any person shall retain any property, or intentionally induce the person so deceived to do or omit to do. So this is a cheating section. So section 403 and 415 are the sections under the Indian Penal Code which are used. So before even taking the criminal action by the banks, there is a process required, and that process is the bank must have a board approved transparent mechanism. The powers are not with the branches, the powers are not with the region, the powers are basically with the complete mechanism that the bank has to make under the bank. They have to put a complete transparent system so that somebody's criminal complaint is filed. It is also held in various cases that the breach of contract is not a criminal, is not a crime. Simply by somebody is not able to honor the commitments of payment of interest and installments, that's not a crime. The only right of the aggrieved parties to approach the civil court to attach and sell securities, like the banks can go to civil court and attach, sell and the unencumbered properties. Mere breach of contract cannot give rise to criminal prosecution under section 420 also, unless the fraudulent or dishonest intent is shown right at the beginning of the transaction. So one focus is on the transaction. Whenever a transaction is done, later on that transaction may turn out to be causing losses to the banks, but the fraudulent intent has to be seen at the time of the transaction, not later on. If the fraudulent intent at the time of taking loan was not there, however later on the intent changed because of the circumstances, that is excluded from the criminal action. So the anything which is right from the beginning is a kind of planned action to take loan, planned action to defraud the banks. Otherwise, later on, while somebody is taking salvage action, at that time it would not be considered as if it is a fraud. So at the time of doing the fraud, the intent has to be there, and later on it may it is exempted. Like later on, if the transaction gets converted into a loss to the bank, that is exempted. That's not. It's a like kind of a judicial decisions that I'm referring to. So it may not be appropriate for the banks to file criminal action against those borrowers who actually had done business for many years, and their track record is good. The intent was good when they took loan. However, later on, maybe for the purpose of saving the company, they might have done something which is incorrect, or which is offensive to the banks. But that doesn't mean that the intent at the time of transaction was bad. Then in this new Companies Act 2013, a new section was inserted, which is section 447. In that section also, the new offense of the fraud in relation to the affairs of the company, which provides that any act or omission, concealment of any facts, or abuse of position committed by any person with the intent to deceive or injure the interest of the company or its shareholder or creditors, whether creditor, since the creditor word is here, whether or not there is a wrongful gain or loss, can be investigated by a serious fraud investigation office established under the Act, and any violation is punishable with imprisonment of up to 10 years. Case of willful defaults can therefore be entrusted to SFIO to investigate whether such defaults amounts to serious fraud under section 447 of the Companies Act or not. So this is also being used as probably Ankit would also share that the most of the cases which goes to SFIO or ED, those are all bank frauds. So Ankit, you can also share, because you also attended one of the ED and
basically, there is a very interesting certificate course from ICAI, which is called Anti-Money Laundering Laws, and that takes care of PMLA, that takes care of SFIO, that takes care of how the ED has powers under PMLA. And my experience was pretty good. There was a lot of good faculty there, which basically on both sides. So some people came in from the department who were talking about the department side, and there were also independent professionals who are dealing with how the ED takes up such matters. And so basically the idea is that there has to be criminal action which is pending, or which is basically there has to be a charge sheet, and based on that, then the ED or the SFIO, they normally start taking action against the person who with whom there is an allegation that he has committed a fraud or committed a siphoning or something like that.
So Ankit, any questions here? Because I think that we have
Yeah,
wasted some time in between.
We should take some questions. So one question is, can the independent director also be classified as a willful defaulter? So my study,
now, as I said, the section 2 subsection 60 of the Companies Act, that defines whole-time directors. See, like that defines an officer. I think the officer is responsible, and this definition of an independent director does not make him responsible for this. I mean, what do you say, Ankit, about it?
Even I think so. I think normally, in normal circumstances, it will not be, unless and until, what happens is that the independent director was perhaps the person who was responsible, or who was actively involved in that decision making process. So unless and until that is proved, it will be difficult to put the onus on the independent director.
So
then we have so there is a question from two people which says that what is the exact difference between diversion and siphoning of funds, if diversion is also for unrelated operations?
So diversion, one, I said the diversion is from long-term, the short-term uses to long-term. That is also a diversion. from short-term uses to some unrelated business is also a diversion within the company. And siphoning off primarily is taking it outside the company. Siphoning off, taking it outside, whereas the diversion of funds within the company, within the
That
subsidiary companies.
diversion most probably will be linked to the intended use. So in case you
Yeah,
took the loan to get a term loan and you ended up, or you took the loan to buy inventory or use it for working capital, and you ended up buying something else. So I think that will be diversion, or you ended up putting the money into your subsidiary company.
siphoning also means like for the personal benefit. That also is very clearly mentioned in siphoning, that the siphoning of fund is for personal benefit, whereas the diversion of funds may be from category to category and from the business to another business, from the company to another company of the group, whereas the siphoning is whereas the money has actually been completely vanished and nobody knows that where has been taken, where it has been taken. So that's what is completely siphoning, where the normally it's fraudulent also.
So Mr. Pradeep Srivastava is asking a very, very important question, and I just lost his question. Give me a second. Yeah, so he says whether forensic auditor is supposed to conclude existence of fraud or not in his report.
The forensic auditor, as far as this RBI guidelines are concerned, RBI is not saying or putting any responsibility on a forensic auditor. RBI is not even putting any responsibility on the forensic auditor. RBI is only trying to gather the information from a forensic auditor, and then the banker has to take an opinion whether it's a fraud as per the RBI guidelines or not. See, this is the RBI, the forensic auditor will determine the intent. That's never seen, that's never possible. The intent would be, it's based on the various track records of the borrower. The bank will decide the intent, the bank will decide the track record, the bank will determine the transaction, bank will report it. The forensic auditor will only highlight the transactions which appears to be fraudulent. And in this insolvency law also, the forensic auditor is only highlighting the transactions. The RP has to determine that the transactions are undervalued, preferential, extortionate, or fraudulent. It is the duty of the RP, not the forensic auditor. The forensic auditor can highlight the facts regarding the bogusness of any transaction, ingenuineness of any party, the KYC, doubtful KYC of the parties, non-existing parties. Based on all these facts and the evidences, the RP will determine the transaction. Yes, Ankit.
Kiran Kulkarni, there's a question from Kiran Kulkarni, and which says that whether public sector bank can file complaint to CBI if there is fraud under Section 447 of Companies Act.
So if the bankers have suffered, if the bankers are feeling that yes, there is a fraud and they have suffered because of that fraud, definitely they have to use this RBI circular. Then why should they go to Section 457 of the Companies Act? Because if the bankers are involved, so they have this RBI circular, they have a complete reporting structure at what kind of amount of fraud, at what report, starting from the state police to the state CID to economic offense wing to the various departments of CBI, and finally, if the fraud is more than 50 crores, to the joint director of CBI. So there is a complete structure there under the RBI guidelines. Why should they go to the Companies Act? Because if the bankers are the creditors, but in case there are other people who are the creditors, where the RBI circular is not applicable, they should actually use the Section 457 of the Companies Act, not the bankers.
Mr. Sudhir Khera is asking that is there any case of unintentional willful default?
There are many such scenarios, unintentional willful default, like when this transaction takes place. At that particular transaction time, it was 10 years back. For the last 10 years, the business was being done very clearly, and there was no default, there was no fraudulent transaction. Everything was going very good. So when the loan was taken, it was good. Now, since maybe something has happened, maybe some losses have happened, and because to hide losses, the promoters may do some kind of dishonest or falsification of books. And in that particular scenario, it is never seen that the promoters have taken away the money to another, or there is no diversion of funds, there is no siphoning of funds. So then in those cases, I think even if the bankers have suffered, as I said, that the breach of contract is not a breach of trust. The breach of trust is that the banks normally, when they give loan, they trust a person that you have my inventory, you have my asset. And in case you are actually breaching the trust by selling those assets and siphoning off the money, when you are selling the stock and siphoning off the money, that becomes the intent. When you siphon off and take it away for your personal gains, that becomes the intent. In fact, there are many such scenarios where the banks have decided to not to declare a person as a willful default. And if we see this total number of defaults in the country and the total number of willful defaulters declared by the banks as per the RBI list, and there is a huge number of defaulters who have not been able to pay their loan, but they are not willful defaulters as declared by the banks. The huge number is there.
So I think you can resume, and if I have more questions, I can take them up.
So this is one segment of my PPT which I prepared for most of the auditors in our country, because what I feel is that this scenario is changing, and under the changing scenario, the role of the statutory auditor is also changing. So first of all, I would like to highlight what scenario is changing. The first part that I would say is the scenario, like since the insolvency law has come, and the Insolvency Professional IRP RP has powers to take information from the auditor. So in case the information is not given by the auditor, the IP can also file a complaint that the auditor is not sharing the information. So there has to be some change in the way that the chartered accountants are doing the audit. Some kind of records has to be kept with the auditors that they can share later whenever it is asked by anyone who is in any RP. Second scenario is that now the detection of default have suddenly started very as fast. For the last so many years, the company was showing profit with just enhancing the asset side of the balance sheet by just increasing the receivables or the stocks. And suddenly when the stocks was 200 crore, and in 1 year the stocks came down to zero. And that also would be highlighting the kind of willful default or fraud by the borrowers. So whenever there is a willful default, see, like even normal circumstances, in case we see the last 30-40 years in the country, the banks were not ready to detect or declare a fraud, or even not a fraud, but then the default. The banks were not ready to detect a default. But now the default can be detected by any employee. It can be detected by any creditor. It may be small or big, and the company can actually go to insolvency very quickly. The auditors would not even come to know that last year this company was healthy as known to us, and suddenly this company has gone to insolvency, and later on it was found by the RP that the stock worth 200 crore is actually nothing. Similarly, there is a section 71 under the IBC which talks about the punishment for falsification of books of account. Any person alters or falsify any books, papers, or securities, make any false or fraudulent entry in the books of account with the intent of defrauding the creditors, there is an imprisonment between 3 to 5 years. Section 147 of the Companies Act, where the punishment for the contravention, that's also there is an imprisonment also, where for willful and with the intent to deceive the creditors and the shareholders. 147 further provides that the auditor will refund the remuneration taken from the company and pay compensation and damages to members, creditors, and government authorities. I think this particular subsection was taken away later on. The National Financial Reporting Authority has also been set up now with vast powers. Of course, not applicable to all the companies so far, but gradually this authority will have the powers to review various balance sheets and also pinpoint in case of any difficulty. The see, like this, these are the changing scenario. So when the scenarios are changing, the standards of the auditing has to be seen very carefully. The CARO should be reported well. The listing agreement, section clause 41 of the listing agreement is also required. The fraud reporting to the central government is also required by the auditor. So when the auditors are finding some kind of willful default or some kind of fraud, there are responsibilities on the auditor that they have to report it. And that report, the auditor should be prepared now to handle the kind of frauds or willful defaults by the auditee. The auditor needs to now educate himself by the detailed due diligence. The RBI Master Circular is very clear about the willful defaulters, because it has to be reported to 4 or 5 authorities in case the willful default. It is also seen that the willful default has also been with the connivance of the auditor by falsification of the books of accounts. That also has to be seen. Whenever we try to see, we should also try to, whenever we are auditing, we should try to find out what kind of statements were given to the banks and what kind of statements were audited by us. In my personal case, I audited one balance sheet, and finally I got a balance sheet from a bank along with a letter that this balance sheet has been submitted to us, which apparently has been signed by you. When I matched the balance sheet with my audited balance sheet, there was a huge difference, and my signatures was the same. However, the figure of the sales and the figure of the purchase was completely changed, and huge crores of rupees were added there. So immediately I submitted a police report, and later on that particular scenario went up to a very big crime. So we were saved, because whenever this report came to us, we immediately informed the bank that this is not the balance sheet that we signed, and immediately also filed FIR. So now there is a possibility of various forensic audits by the bank or by the IP. As I said, so based on these amendments, the auditor's duties are in fact increasing day by day. Auditors' duties are increasing, so their risk is increasing. So I am saying that they should be more cautious in signing the balance sheets. So this is the part that we would like to say, that this is for the banks, this is for the frauds, and this is for the willful defaults. I would be starting the transaction audit under the IBC and the practical difficulties, which would be more interesting to the audience, because this is a new subject. Before I do that, I would see in case there is any question from Ankit.
So we are at 10 minutes to 6 o'clock. So yeah. I think what we can, so you can decide how much you want to take it forward with respect to the IBC transaction audits. I will speak out some questions. So
I think we'll spend this time on the questions, yeah. And because we will start this subject of transaction audit, because this would be very, very practical, because we have gone through many such audits and we've gone through many such cases. As AAA insolvency, we might have filed more than 70 applications to the adjudicating authority for section 43, 45, 66. So this all this experience that we would share with the participants, so that would be really good. That would be on next Sunday. But like, let's see what are the questions today.
So what I'm doing is I'm trying to take those questions that are relevant to today's slides, and I'm kind of I am assuming that your presentation next Sunday will be covering the IBC related questions with respect to transaction audit and other parts.
Yeah, so, I think some of the IBC, first of all, we should take this the willful defaulters and the fraud and RBI.
I will give priority on those questions. So Mr. Nadeem Laji, he's asking that directors are not personal guarantors, but they have diverted funds and has done all willful defaulters activities, and business is now closed with huge bank outstanding. Can we restrict directors to leave the country or impound the passport under sections of criminal action for willful defaulters?
Yes, see, in case the bank, as per the entire process defined under the RBI circulars, willful defaulter or the red flagging of the account, fraud account. Once the fraud account is declared, then the complaint to CBI. Once the CBI once the complaint to CBI is filed, the CBI will only do some initial investigation because like I have seen CBI taking actions in 3 or 4 days, and I have been given to understand by various banks that in some of these states the CBI is very, very active in some of the frauds which are less than 25 crores. But in case of Delhi, where the frauds of more than 50 crore comes, this also is very, very active nowadays. And in Punjab, we have seen a lot of searches, a lot of raids, and even in my case, Rotomac of Kanpur, I have seen during the CIRP the raids was conducted, and that was also within about 15 days of the complaint filed by Bank of Baroda. So for the participants, I would be very happy to share with you that why I took up this fraud subject. One, that I also wanted to update myself because see, the banks are kind enough to give us all the big names in the country who have done fraud with the bank, starting with the Nirav Modi companies to Mehul Choksi companies like Gitanjali Gem, Vikram Kothari companies, and the Junjunwala companies, and even otherwise this wherever the SEBI defaults, unauthorized collective schemes, see various such companies where the assets are attached by the investigation agencies or against the criminal offenses, those are with us. So like it was very, very important for us to understand why the banks are actually trying to go through their own process, while the IBC has a complete process of first of all adjudication from the NCLT and then the special courts under the Companies Act under section 236 of the IBC, where the IBBI would be the prosecutor. See, I wanted to understand very clearly, of course, like in my experience, I have dealt in the past, a lot of people under stress, a lot of willful defaulters. I have represented before the banks on behalf of my clients that this person is not a willful defaulter. I have even represented before the branches that this is not a fraud, this is a business scenario. So I've done a lot, but I just wanted to update myself because of the various fraud cases that has come to AAA. And I wanted to understand the bank's mindset when they are not accepting the resolution plan from the promoter, when the promoter's behavior, their intent is not clean. So that very, very important part that I have seen. So what the question is coming, that's very clear that if CBI tries investigation, then the CBI definitely would hold the passport and would not allow any foreign travel. So however, as far as the foreign travel is concerned, this is considered to be a fundamental right, and a person can specifically apply to the court for 1 or 2, even if for then I have seen then some people are getting their passport back for a travel, and when they come back, they also have to supposed to give it back to the investigating agencies.
I'll take up the next question. Mr. Sudhir Khera is putting up a very interesting question. He says that in forensic audit reports, there's generally a disclaimer that this report is only for perusal of the member banks and should not be used for any other purpose. Are they justified? So, and also I think beyond this, what we can also briefly talk about is the disclaimers that otherwise make the forensic audit unusable.
This is a very, very important question. I thought that I would be taking it again on the next Sunday, because this is a very important, like the role of the disclaimers, in fact, have diminished our efforts for finding defaults, because the disclaimers given by the forensic auditors were huge. The kind of disclaimer that they had given, one, that this report cannot be used by anybody else other than the RP. Second, that the information given by the RP or by the company was not verified independently by us. Thirdly, the documents given by the RP or the company was not independently verified by us. The words used by, like, the transactions are suspected to be like this. The transactions are while I'm convinced with one scenario that the auditors are not supposed to determine the the transaction under the under relevant section. They have to highlight a transaction, and it is the duty of the insolvency professional to determine the transaction under what section it will fall. See, but then the reason of the most of the international brands, while they give this kind of disclaimer, is that if the same report is used by the bank for a complaint to CBI, then the same auditor might be called. The same auditor might be called for verification, for witness to CBI proceedings. That's what they scare. Then that is the reason that they write. So in one or two cases, then when we insisted that we have to use this report and we need your consent, because the banks wanted to use the same report for filing fraud under RBI framework, and then we approached the same international firm that we want to use this report, and then the international firm came out with a proposal that if you want to use this report for the RBI framework, then we would charge this much now, and later on, in case we are invited for any clarification, then based on the per hour or per day, that would be charges, and in case we would be called for any hearing, then this would be the charges. And they were asking the creditors to sign that arrangement, then only they will give a permission. So that was a scenario. Of course, like when we now appoint a forensic auditor, we are saying that the first and foremost, that the arrangement letter that we give to all the forensic auditors, that this particular report can be used by the RP and any of the members of the committee of creditors. So this we have solved now, and this is mostly accepted by the firm, leaving some which are not accepting. So this is the Ankit, anything else?
Another question is whether banks should share forensic audit report with the RP.
Certainly yes, because the banks, in case the banks will share the, because I'm even convinced with this subject, if the banks have got this forensic audit done very recently, and the books of accounts are very small, and the RP finds himself capable to do and find the transactions, then the RP can even use that report and determine some of the transactions which are in the look back period and report to adjudicating authority, even if the bank has already used that report. Even if the bank has already used that report under the RBI framework, the RP can still use that report, determine some of the transactions without even waiting for the report of his own transactional auditor, or even not appointing his own transactional auditor. Because I would come to the next part of the webinar where I would actually say that this appointment of a forensic auditor or a transactional auditor under IBC is not mandatory. If the insolvency professional himself can do that, then also it will be considered as that he's done his part, because the only thing that he's trying to say that in case this is just for the sake of shifting the responsibility to somebody else. And secondly, nobody can say that a insolvency professional would also be a forensic auditor and will be an expert in finding the transactions, because the insolvency professional can be an engineer, he can be a management person, he can be a company secretary, he can be a cost accountant. Not necessarily all the insolvency professionals will be chartered accountant, and that too specializing into the forensic audit. Yes, but in case some insolvency professional is able to justify that I have done it myself, nobody can accuse him that he has not done his part later on by not appointing a transactional auditor. Yes, Ankit, next question.
So then, of course, conclusiveness of the forensic audit report brought in a lot of comments that RBI's instructions, IBA's instructions require the forensic audit reports to be conclusive. And I think that's also already taken care of. I will just
like as far as the IBA is concerned, IBA is working under the RBI framework, but then the RBI in their circular has never said that the forensic auditors should classify it as a fraud. Forensic auditor it is to be appointed, but it is the IBA saying that it has to be conclusive. If the forensic auditor has highlighted the transactions, what further conclusion is required from the auditor? Should he become adjudicating person? I think that he has highlighted a transaction, whether it is fraudulent or it is transactional, or it is on account of the stress, that has to be decided by the committees which are made under the RBI guidelines. And the transactions highlighting is the job of the forensic auditor.
The way I see
disclaimer.
it is that how a forensic auditor or a transaction auditor will work is he will look at all the transactions, he will enumerate them. He will also give a chance to the promoter in some circumstances that they can explain some transactions, and those allegations, the counter proof, counter documents that he has received, he will simply put in a report with all the facts around that, around the transactions. And if there are no transactions that he is able to find which can result into some kind of a diversion or siphoning off, then there is no evidence in the report.
I think the other part which has been in one of my case, the NCLT bench in an open court said that you are filing the application without even determining the transaction. You are filing an application under section 43, 45, 66 without even determining. Let me understand when you determine the transaction. Let me understand where you have given your note while determining the transaction. You can take the clue from the forensic audit report, but determination is your role. That was announced by one of the NCLT member, and that's not something which is required by the forensic auditor. Forensic auditor has to give a report which should be clear transactions, which should be supported by the documents, and he should not give a disclaimer like that the documents are not verified by him. He should not give a disclaimer that the further information was asked but was not given to us. So these kind of disclaimers are in fact not giving any result. As far as the disclaimer that it would not be used by any other person, that's only a financial implication. Even if it is used, nobody can say that the information given in this report cannot be used because the financial arrangement has not been done with the auditor. So that nobody can say. The courts will say that yes, the report is signed by a forensic auditor, the transactions are supported by documents. Even if the transactions are reported without I can report a transaction without even attaching the forensic audit report. I can report a transaction with the ledger accounts, with the other evidences, and even if it is not there, in fact, I have filed many such transaction applications which are not covered by the forensic auditor by the transactional auditor, but I have filed those transactions as a avoidable transaction. So, as far as the transactions are concerned, the transaction should have proof. The transaction should have all the documents to verify and make a case. Because the case is not based on the forensic auditor's report. Case is based on the documents, and the report may be, even if it is written in the report, but there is no document to substantiate that report would not be considered as complete, and that would not be considered as the application would not be accepted by the adjudicating authority. Yes, Ankit.
So I think I have covered most of the questions that we had with respect to. One question is that is non-cooperation by borrower considered as early warning signal or fraud?
Non-cooperation by the borrower while dealing with the bank,
providing information.
While dealing with the bank, of course, because like I said that this is one of the early warning signals that the borrower is not submitting the financial statement, borrower is not submitting the stock statement, borrower is not submitting the renewal proposal, borrower is not liking when the bank is visiting the bank, always trying to defer the bank's visit for verification of the current asset. That's a very big signal. That means that the borrower is actually trying to hide something if the borrower is not transparent. That's a very big, but then I'm not sure whether you're asking about the non-cooperation during the insolvency process or non-cooperation in the normal banking operations. If it is during the insolvency non-cooperation, of course, that we all are facing the non-cooperation and like not providing information which is sufficient for the forensic auditor. So that, of course, is one of the issues.
I think if the promoters are not cooperating with respect to providing any report, any information with respect to valuation, with respect to anything else, and I'm talking about an insolvency case, CIRP matter. So there, you can't really say that there is a fraud or there's diversion or there's some problem with those transactions when you have not even looked at those transactions. What you can do at the most is say that go to NCLT and say that the promoters are not providing information.
See, but that's not really effective nowadays. That in case I go to NCLT and say that the promoters are not providing information, what I understand is that we should use other methods for taking information from the promoters. Of course, application has to be filed, and the effectiveness of 19.2 application, of course, has been reduced over the time. Presently, it is not giving much results at some of the benches. It is giving some good results at some of the benches, but at some benches, it is not giving good results. But yes, that as an insolvency professional, we don't have any other option except to file their application. But it is not being considered as very positive by the benches also. The benches are saying that the once application is filed, the insolvency professionals are not making efforts to get the information or to obtain the information. So what I am trying to say is that while the application is filed, we should also try to get the information. We should also try to explore the possibilities of getting information from third parties. We should go to the income tax department. We should go to the registrars. We should go to various other departments that we have powers to get the information. But in the then it will be considered as yes, we have made the efforts. So simply by filing an application under section 19 subsection 2 and not making any further efforts to get the information, not even going to the office of the company where the records are there and trying to find out the files, because see, in many cases when I was asking the information and I filed the application, and then the promoters actually reported in they submitted a written argument that the entire company was under the possession and custody of the RP. We had all the information, we had all the documents, but we were not given any access, so we couldn't file that. And then it was like, then a video film was it was a joint inspection of the premises was done, and then finally they said that the documents were here, and since this particular premises was in the custody of the RP for 1 year, so we don't know where the document has gone now. So we have no information because we were not allowed to be there in the office for 1 year. So now we are coming to the office and we are not finding those documents, so we are unable to provide those documents because we feel that it has been taken away by the RP. Even these kind of allegations have come to us. So this is everyone will prepare for their defense. So we actually have to be very, very cautious. This transaction audit under IBC is a very, very important issue. There are a lot of questions. I think that the next session that we will have on the next Sunday, maybe in case we would stretch it a little longer, because I would like to complete it for the entire research that I have done. Ankit, I think we can conclude.
I think we are, so we are 10 minutes above time, and I think we can thank everyone. And I regret the technical difficulty that we had today. We will be using the same link, so you don't need to register again for the next webinar because it is part of the series, and you will automatically get email from Zoom with respect to the next webinar.
So the recording of this webinar and the recording of the next webinar would be available on our YouTube channel, AAA Insolvency Professionals, and that would be uploaded tomorrow. So that would be seen and see that in any case, the entire PPT is also available in the recording. So that can always be seen, and in case there is any specific word or specific section is required for anyone, that can be seen from that recording itself. So thank you very much, participants. We apologize for the technical failure for about 10 minutes in between. And I think that this particular session was not exciting as the next one would be. The next one is the very, very current. And of course, this is also very current because see, most of the cases that we are handling, the banks are taking action under the RBI framework, also while the RP is taking the action under the insolvency law. So we need to understand both while we are conducting our insolvency practice, while we are actually understanding also. So this is what is final from us. Thank you very much. And as I always say that there is no objective of this these webinars. It is only our way of learning. Thank you very much.
Thank you, everyone. Thank you.